Welcome, curious minds, to the deep dive. This week, we're jumping headfirst into some really crucial economic sources. We're looking closely at a weekly economic outlook and strategy briefing, focusing specifically on September 8th to 12th, 2025. Our mission really is to boil down the key insights for you, give you that sharp edge in understanding the high stakes for global markets, for the Fed, and, well, how it all fits together.
Yeah, and the sources we're looking at suggest this isn't just, any week. It feels pretty pivotal. There's this strong market belief, almost a near certainty, the source calls it, that the Federal Reserve is about to deliver an easy rate cut, but, and this is the big but, this idea is bumping right up against some serious headwinds. We've got stubbornly persistent inflation and also this growing gap, this divergence in what central banks are doing around the world. So we're here to explore if the market's optimism, its sort of dovish enthusiasm, is maybe about to get a reality check.
It's really fascinating, isn't it? How baked in that expectation for a Fed cut seems to be. It feels almost like a done deal in the market's mind. But as we unpack the calendar for this week, you'll see there are these key data points that could absolutely validate that view or quite dramatically flip the script entirely. It really is one of those weeks where the numbers could shift global sentiment in a big way.
That's a great point. And look, before we really dig in, we need to mention the disclaimer from the source material itself. This deep dive is purely for informational and educational purposes, okay? It is not financial advice. Our job here is just to explain what these reports are saying, not to tell you what to do financially. We're just guides to understanding these, frankly, complex forces.
Right, exactly. So with that crucial context set, let's get into why this week is so important. Starting with that jam-packed calendar you mentioned, these indicators could genuinely reshape the outlook. This isn't just background noise, is it? Oh, far from it. These data points this week, they're the last and maybe the most critical inputs that are going to shape not just if the Fed acts, but the size and the whole tone of their decision. That's coming up really soon, September 16th and 17th. And it's especially important after what we saw last week. Remember that pretty abysmal non-farm payrolls report? It really showed a significant cooling in the labor market, which ironically has just poured fuel on those rate cut expectations.
Okay, so let's tick through the key reports everyone's watching. Wednesday, September 10th, 8:38 a.m. Eastern. We start with the U.S. Producer Price Index, PPI, for August. That's month over month, year over year, and the core number 2. This one's flagged as critical.
It is indeed. PPI looks at inflation right at the wholesale level. So what businesses are paying before things get to us consumers? Because of that, it's often seen as a leading indicator for the CPI, the consumer inflation number. We'll be looking closely at the headline number, but also that core PPI. It strips out food and energy, the volatile stuff. Just like core CPI, it gives a clearer view of the underlying, maybe stickier price pressures. So context, the previous month-over-month PPI was 0.9%. The consensus now is for it to drop to 0.3% for August. And core PPI year-over-year was 3.7%, expected to ease slightly to 3.5%. These numbers tell us about those pipeline pressures.
Okay, then fast forward to Thursday, September 11th, 8:15 a.m. Eastern. We look across the pond to the Eurozone ECB interest rate decision, another one to watch closely.
Absolutely. The European Central Bank, the ECB, is widely expected to just hold rates steady. Right now, they're at 2.00%. This is really important because it highlights that divergence we talked about. You've potentially got the Fed leaning towards cutting rates, while the ECB seems pretty content to stay put. And that creates some interesting dynamics, especially for currencies like the euro versus the US dollar.
And just 15 minutes after that ECB decision, 8:30 a.m. Eastern on Thursday, back here in the U.S., we get maybe the number of the week, the U.S. Consumer Price Index, CPI. Again, August numbers, month over month, year over year, plus the core CPI. This is the main inflation gauge, right?
Without a doubt. This one is absolutely critical for the Fed's upcoming decision. It's the direct test, really, of that easy cut story the market's telling itself. So last month, CPI year over year was 2.7%. The consensus for August is a little nudge up to 2.9%. And core CPI, remember, excluding food and energy, was 3.1% last month. The expectation, it holds firm right at 3.1%. Any surprise here, higher or lower, could send some serious ripples through, well, pretty much all markets.
And right after the ECB rate decision on Thursday, 8:45 a.m. Eastern, we also need to pay attention to the Eurozone ECB press conference.
Yeah, President Lagarde's comments there will be parsed very carefully. Markets will be hunting for any little nuance, any hint about where policy might go next, especially as this great divergence theme seems to be solidifying.
Okay, and then rounding out the week, Friday, September 12th, 10:00 a.m. Eastern, we get the preliminary U of Michigan consumer sentiment reading for September, plus those really crucial inflation expectations numbers, the 1-year and the 5 to 10-year outlooks, another key moment.
Exactly. This gives us a real-time snapshot of how consumers are feeling. But for the Fed, honestly, it's the inflation expectations part that's super critical. People starting to expect high inflation to stick around because that can feed into their spending habits, even wage demands. The Fed watches that like a hawk. Previously, the one-year expectation was 4.8%. The consensus for this month is a slight dip to 4.6%. We'll see.
Okay, so that's the packed calendar. Now, how do we piece this all together? What does it mean for the bigger economic picture we're trying to understand?
Well, if you step back and connect those dots, the market's navigating this really complex landscape right now. You've got, as we said, a rapidly cooling U.S. labor market. Okay, that points towards easing. But inflation is proving really stubborn, sticky. And then you layer on this growing difference between what the Fed might do and what other central banks like the ECB are doing. It's created this kind of bad news is good news environment for now. Weak data like those job numbers actually boost the odds of the Fed cutting rates soon. But this week's inflation reports, they are the real test of that whole narrative, that dovish conviction.
Right. This is where it gets really interesting. The market seems so sure, almost locked in on a Fed cut. What's really driving that certainty?
That certainty really surged after that shockingly weak non-farm payrolls report last week. Remember, only 22,000 jobs created. And the 3-month average dropped way down to just 29,000. I mean, that's undeniable evidence the labor market is cooling off significantly. And it seems like that evidence has kind of tipped the scales inside the Fed, shifting the focus maybe more towards employment concerns, potentially eclipsing inflation for now. So the market, looking at futures pricing, sees a 100% probability of a rate cut. The only question left seems to be how big the cut will be. And that expectation has been a huge tailwind for stocks and other risk assets unless inflation throws a wrench in the works this week.
But there's that big yellow flag, as you called it, still waving frantically, isn't there? Inflation hasn't gone away, even with softer job numbers.
Absolutely. That's the crux of the issue this week. The labor market might be flashing green light for the Fed to ease, but inflation is that major yellow, maybe even flashing red flag. Both PPI tomorrow and CPI on Thursday are expected to show inflation is still stubbornly above that 2% target the Fed wants. We mentioned the consensus, CPI potentially ticking up 2.9% year over year, core CPI holding at 3.1%. And what's really interesting and maybe complicates things for the Fed is that some economists are pointing to the pass-through effects of trade tariffs as a key reason for the stickiness. So it's not just about domestic demand maybe cooling off. There could be these external supply-side pressures pushing prices up too. That makes the Fed's job much harder, right? It's not just about tweaking interest rates if tariffs are playing a big role. It adds this whole other layer. And it creates a significant dilemma. If they cut rates while inflation is actually picking up steam again, they risk looking like they're okay with higher inflation, or worse, validating fears of stagflation. That could be seen as a major policy mistake. So yeah, a hotter than expected inflation print this week.
That's the number one risk that could really force the market to rethink how dovish the Fed will actually be.
And this isn't just a U.S. story. You mentioned the divergence. Across the Atlantic, things look quite different. How does that global policy gap play into things?
That's becoming one of the major themes in global macro right now, and this week really highlights it. While the Fed looks ready to cut, the ECB meeting on Thursday is almost certain to keep its main policy rate on hold at 2.00%. Why? Well, the Eurozone economy has actually shown some signs of improvement lately, and their inflation is hovering closer to the ECB's 2% target. So there's just less pressure on them to ease up. This difference, this transatlantic policy gap, is a really powerful force, especially in the currency markets. It fundamentally supports the euro against the U.S. dollar. Of course, everyone will listen closely to what President Lagarde says in the press conference for any clues about the future. But for now, that basic contrast of Fed looking to cut versus an ECB holding steady is likely driving global money flows, maybe making European assets look a bit more attractive on a relative basis.
Okay, we've painted the big picture, identified the key themes. Now, let's sort of put on our market strategist hats for a moment. Let's dive into how each of these critical events might actually trigger reactions across different markets, stocks, bonds, currencies, commodities, using what the source calls intermarket catalytic mechanisms. Basically, how one thing moving can cause a chain reaction. Let's start with Wednesday's U.S. Producer Price Index, PPI. How does this wholesale inflation number set the tone, and what are the potential market reactions?
Right, but PPI is that first read on price pressures this week. It really sets the mood for the inflation narrative. If it comes in hotter than expected, let's say core PPI month over month hits or goes above plus 0.4%, which the source uses as a kind of validation threshold, that's a strong signal. It suggests maybe those tariff effects are pushing costs up through the supply chain. The source calls this the pipeline pressure cooker scenario. What happens then? Well, you'd likely see U.S. Treasuries sell off, meaning yields go up as the market dials back expectations for big Fed cuts. The U.S. dollar index, the DXY, would probably catch a bid, get stronger. And stocks, they could face some pressure. Higher input costs aren't great for profit margins, plus a less dovish Fed is generally a headwind. Gold might dip a bit too, mostly because the dollar is stronger. Now, flip side, if PPI comes in cooler than expected, that's a sigh of relief. It supports the Fed easing case. So you'd expect bonds to rally, yields fall, stocks to rally, the dollar to weaken, and probably a boost for commodities like gold and oil.
Okay, got it. Next up, Thursday's ECB interest rate decision and press conference. The core of that great divergence idea, how might that play out?
Yeah, the decision itself, holding rates at 2.00%, is pretty much expected, as we said. So it's really President Lagarde's press conference that will move markets. If she sounds hawkish, really emphasizing the need to watch inflation, maybe downplaying growth risks, that reinforces the policy divergence. This fits the source's divergence trade thesis. In that case, you'd expect the euro to strengthen quite a bit against the dollar. Euro-USD goes up. German government bond yields, bunds, would likely rise. European stocks might feel a little bit of pressure from tighter policy expectations there. But what if she sounds more dovish? What if she focuses more on risks to economic growth? Well, that would kind of narrow that perceived policy gap between the ECB and the Fed. In that scenario, the euro would likely weaken against the dollar. German bunds would rally, yields fall, and European stocks could get a lift.
Okay, makes sense. Now for the main event, arguably. Thursday's U.S. Consumer Price Index, CPI. You called it the ultimate test.
It really is.
Yeah.
This is the number that directly challenges or confirms that whole market narrative. Is inflation sticky enough to actually make the Fed pause or even rethink this expected pivot to easing? The market is leaning heavily one way towards an easy cut, and this CPI report has the biggest potential to disrupt that view.
So let's game it out. If CPI comes in hotter than expected, say core CPI year-over-year prints above 3.2%, what happens then across markets?
That's the scenario the source labels the stagflation spoiler. Oof. It would signal inflation isn't just sticky, it might actually be re-accelerating. That puts the Fed in a really tough spot. Market reaction. Expect Treasury bonds to sell off sharply, meaning yields spike higher. The U.S. dollar would likely rally strongly as markets price in a more hawkish, less accommodative Fed than they thought. Equities, probably a significant sell-off. Fears of stagflation, that toxic mix of slow growth and high inflation, would surge. Higher interest rates hurt valuations. Gold might initially fall because the dollar is so strong, but it could find a bid later as a stagflation hedge. Real estate? Crypto? They'd likely sell off too in that risk-off move. The source's thesis here suggests maybe underweighting stocks generally, shorting treasuries, betting prices fall, being long the U.S. dollar index, and maybe using gold as that stagflation hedge after the initial dollar move.
Okay, that's the ugly scenario. What about the flip side? What if CPI comes in cooler than expected? Maybe core year-over-year is at or below 3.0%.
That's the all-clear for easing thesis, according to the source. That would be seen as confirmation that disinflation is back on track. It basically removes the last major obstacle for the Fed to go ahead and ease policy, maybe even quite aggressively. Market reaction? You'd see a powerful rally in Treasury bonds, sending yields tumbling down. The U.S. dollar would sell off, likely quite sharply. And equities. Expect a major rally, probably led by those sectors most sensitive to interest rates, like growth and technology stocks. Gold, silver, oil, industrial metals, they'd all benefit from a weaker dollar and easier financial conditions. Real estate, cryptocurrencies like Bitcoin and Ethereum, likely strong rallies there too. So this implies maybe overweighting tech and growth stocks, going longer duration treasuries, shorting the dollar, and generally being bullish on commodities and even crypto.
Wow, big swings depending on that one number. Okay, finally, we wrap the week on Friday with the U of Michigan consumer sentiment. How does this final piece fit in? What's the key takeaway here?
Yeah, it's kind of the epilogue for the week, giving us a real-time sense of how consumers are processing everything. While the headline number matters for confidence, the market really zooms in on that inflation expectations component. If those expectations spike higher, that's hawkish. It suggests consumers think inflation is sticking around, which is exactly what the Fed doesn't want to see. They worry about expectations becoming unanchored. A hawkish. The source highlights a particularly nasty scenario. What if sentiment plunges and inflation expectations spike? That's described as the most bearish stagflationary outcome. In that case, bonds would sell off on inflation fears, stocks would sell off sharply on growth and inflation fears, the dollar might rally as the Fed looks hawkish, but gold would likely rally strongly as that ultimate stagflation hedge. Now, what if sentiment plunges, but inflation expectations stay stable or even fall? That's seen as more straightforwardly recessionary signal. Confidence is crashing, but inflation fears aren't rising with it. In that case, bonds would rally powerfully as the market prices in a deep slowdown and expects much more aggressive Fed cuts down the line.
Stocks, especially cyclical ones sensitive to the economy, would sell off, and the U.S. dollar would likely weaken. This links to the source's consumer capitulation thesis, suggesting maybe underweighting cyclical stocks, going long-duration treasuries, and potentially shorting the dollar against safe haven currencies like the Japanese yen or Swiss francs.
Wow, what a week indeed. It genuinely feels like global markets are standing at a massive crossroads here. These key data points we've walked through could either cement the current view or just completely blow it up. It really sounds like the Fed is trying to land this huge plane in a serious crosswind, doesn't it? Balancing these competing forces.
That sums it up perfectly. That's the challenge they face. The market right now is positioned, maybe even leaning heavily for that easy Fed cut, mostly because the labor market has cooled. But this week's inflation data, especially that CPI number on Thursday, is absolutely the final exam for that assumption. And then you throw in that great divergence with other central banks like the ECB, just adds another layer of complexity. It makes for a deeply complex, really fascinating landscape. Definitely requires careful watching this week.
Absolutely. This deep dive has really laid out that delicate balance, those economic forces pushing and pulling against each other. So as you, our listeners, watch these events unfold this week, maybe consider this question. What if that core market assumption, that easy cut narrative, is fundamentally flawed? What if inflation proves much stickier or the Fed is more hesitant than expected? What would that mean for how we understand these broader economic trends and maybe even how we think about our own individual financial decisions? Definitely something to keep thinking about. Critical thinking is always key, especially when there's so much noise out there.